In this video, we're going to be reviewing the trade ICT took today, and coincidentally enough, he had 1 win and 2 losses. We're going to be going over his analysis, where his entry was, why he took his entry, why did he think it was going higher. We're going to analyze that together, so let's go ahead and get into the video. Here's the video right here, actually playing right now as a recording. This one is a little bit longer because it plays out in real time. We can see that he enters 15 contracts and ends up with 25 contracts total, and his final target being the top of this range right here. If you know anything about ICT, you know that this is a market maker buy model. That is what he was expecting. Here's our initial consolidation. Here's our first stage distribution. Here's our second stage distribution and our smart money reversal, which also coincides with the opening range gap, which I'll show here in a second. Then we expect price to reverse after the smart money reversal, go to the original consolidation or accumulation, and then push through that, which we see here based on his targets. We can see his target right here, his high there, and his ultimate target up here for a giant $63,000 profit. Now let's go over to the charts and let's take a look at this. If you don't know what the opening range gap is, let's look at that here. If you are trading on Trading View, if you go down to the right hand side, you'll see this little toggle here. If you go to regular trading hours, it then removes all the trading after 1600 and all the trading before 9:30 a.m. So you see this big gap right there. That is the regular trading hours. So looking at a 1-minute chart, we here see the last ticker here and the opening bell at 9:30, and this is where we had our sell-off, and we sold off all the way to here. And this is ICT's initial entry, which if you run just a nice horizontal line, lines up with the closing of this opening range gap. Now ICT expects the price to drop and then reverse, that being the smart money reversal. Now we need to go to a higher time frame and really analyze, why did ICT think we were going higher? And to be honest, it was the same analysis I had, and as a result I got stopped out on a couple positions as well. Looking at the 1 hour, here's what we got. We have this volume imbalance and a previous day high right here, and then we have the buy side liquidity sitting right here. This was actually his target that he set. We have 16,050, and I believe his high was 16,051.5. That was his target. Here we have the full time frame right here. This is the opening, our sell-off. If you look left, we see this volume imbalance right here. That was my initial target to the upside, and then we had this buy side liquidity and another 15-minute fair value gap that would have been the higher end target for price to move to. So when you get so close and then you move away, there is somewhat of an expectation that we are going to move back up into that level. ICT had the wrong bias for the day, and as you can see in his multiple losses, he purchased another one right here after he took off 5. It stopped him out right here, so he got back in at this right here at this fair value gap, assuming that it was going to just do a small retracement and move higher. Now if we, in post analysis, if we take a look at the charts, if we look at the 5-minute right here, one of the characteristics of a market maker sell or buy model is price is expected to run through specific key levels, and then they come back up to those specific levels. So if you look right here, price ran through this and through this fair value gap, and then we see price come back up to it, almost to the tick. This is a clear indication of order flow. We see that order flow is moving down, and it hit to the tick, indicating that we wanted to move lower. I actually was hoping to get this play. I missed this entry and was really disappointed because I was looking for that as a potential entry to the downside. ICT then took his last entry at this order block right here. Assuming that we already balanced this area right here, we are going to bounce off this and move higher, and initially we did, but this one stopped him out even faster. My takeaway, if you look right here, he got 10 contracts and his stop loss is only $1,100. In this case, it was about 5 handles. Your stop loss can vary from 5, 10 to 15. ICT had his son Cameron doing a 20-point stop loss. As I said in the last video, I'm understanding more and more that giving your trade room to breathe is essential, but at the same time, placing your stop loss in appropriate areas is very key. Below order blocks, below the wick of a fair value gap candle. These are key areas to set stop losses that are appropriate. Above of intermediate, high, or low is an appropriate area to set a stop loss. This is to make sure you don't get wicked out, and if it does stop out, there shouldn't be another reason to get in for the same move unless there is a further lower discount PD array that you can actually bounce off. For example, his entry right here was off of this PD array right here. This BISI overlapping with this order block. It bounces right off that. That was his entry. Once that failed, there's no other entry or no other discount PD array in this range. There is no other entry. In this case, he had another entry, which was this order block right here, and it bounced off that. Both seemingly moving in the right direction, but ultimately failed because the higher time frame analysis was bearish for the day instead of bullish. And going back to this key low right here on a market maker sell model is a key indicator that lower prices are coming. If you like videos like this where we review ICT's trades, evaluate them, look at his entries, and see how we can improve on our own trading, consider liking and subscribing to the video. Thanks for watching, guys. We'll see you in the next video. Take care.